Hello and welcome. My name is Dr. Ola Brown, and I've put this course together because there's a lot of people that want to get into angel investing or understand venture capital. A lot of entrepreneurs, a lot of executives want to get into angel investing. So they want to be able to invest in tech companies, invest equity in other types of companies, and they don't quite know how to go about it. So that's why I decided to focus on angel investing. There are entrepreneurs in the technology business that might be wanting to raise venture capital as well, and not sure how to go about it, not sure how venture capitalists think. And there also might be people wanting to develop a career in venture capital. Bankers, for instance, that work in retail deposit banks, investment bankers, accountants, that might want to understand a bit more about venture capital. This course is for you. Now, before I go on, I have a big disclaimer. I'm recording this in Lagos, Nigeria, where I currently live, and there's a lot of African references in this lecture series. And the reason why I've put in a lot of African references is because I watch a lot of lectures in YouTube, and all of them seem to have American or British or European references. And I wanted to make this not just an academic lecture, but a localized academic lecture. So I hope that I can explain any expressions that I'll be using or any sort of African examples that I'll be using, but you'll just have to excuse me for using them if you're not from here. And hopefully, if you've never been to Africa, if you've never thought about Africa before, in fact, in any detail, this course will not only teach you about investing, angel investing and venture capital, but you'll probably go away with a few interesting cultural references as well. So the structure of the course. One of the collectives that we run, the Flying Doctors Healthcare Investment Company, is a collective that invests in healthcare and, well, health tech more like, and invests in fintech as two specialist areas. And we have members in our collective that are people that are interested in angel investing. They are interested in putting money into either health tech startups or fintech startups, and again, not quite sure how to go about it. So under members of the Catalyst Fund are people that receive education from us. We take a lot of the burden of investing away, such as due diligence and some of the things that we'll be discussing in this course. We also try and de-risk the investments to a certain extent, and then present them to our members. We don't take direct investments from our members, so the members decide whether they want to invest in a particular company, but what we do is provide the education and facilitate that. But at the end of the day, each member decides whether they want to invest or not, and they're usually investing alongside us and alongside our main fund anyway. So what are we going to be talking about in the process of this course? There's probably two sets of people watching this. There's our Catalyst Fund members who will be watching it as part of their membership. It's free. There's also a paid course that anybody can watch. And this is what we'll be talking about. We'll be going through an introduction to angel investing and venture capital. It's short, about 5 minutes of definitions and explaining angel investing and the difference between angel investing and venture capital. And then for the second piece, because I know that there's a lot of terminology that I'll have to refer to over and over again through the rest of the course, of 10 modules. So in module number 2, I go through a guide to all of that terminology to make sure that at least all of the things that we say regularly in the angel investing and venture capital world, we can get you up to speed in one lecture. Then we go into fund structure and the thesis of a venture capital fund. Now, even though the topic is fund thesis and structure, I will be talking a little bit about angel investing theses as well, because some angels are thematic angels and they don't invest in a generalist manner, but they only invest in sectors that they know. And we'll look at the evidence and the data that kind of backs up that strategy. And then we'll be talking about venture capital in the economy. I studied economics at master's level, so I'm an academic economist and I love macroeconomics. So we'll be talking about the macroeconomics of venture capital and why it's so important, particularly in developing countries like Nigeria. We're halfway through at module number 5, and we'll be talking about 3 really important topics all in one lecture. We'll be talking about deal sourcing. How do you get the deals in the first place? We'll be talking about valuation. When you want to invest in one of these new tech startups, how do you come about what value you invest in? And you hear a lot of people saying, oh, you know, this tech stock is overvalued or undervalued. And we'll just be going through that and trying to work out different ways of valuing these startups that have no record. So if you're investing in a Dangote group of companies, for instance, you probably have like 20 years of every audited account that he's ever submitted to the Nigerian Stock Exchange. So it's a lot easier to put a value on Dangote than it is to put a value on a PowerPoint presentation that somebody has given you with no track record in business. The person usually has no track record in business, very little track record in the sector that they're going into, and just, you know, promising you that they're going to make a lot of money. So how do we put values on these companies? And then how do we do due diligence, and what kind of things do we look at during the due diligence process? Number 6, we're going to do a postmortem, a few postmortems actually. So we're going to be looking at why a lot of companies that tech investors have put money in end up failing. Now, almost every venture capital expert or practitioner or angel investor has put money into companies that have failed, unless they're not doing that many deals. So it's not going to completely insulate you from ever making an investment in a company that fails. But we're going to look at the common reasons why companies fail. So at least you can have some sort of blueprint as to, okay, this is the procedure that I'm going to follow to try and prevent these failures. And then we're going to look at a really interesting topic, particularly in Nigeria right now at this time: cryptocurrency, blockchain, NFTs, central bank digital currencies, and the future of money. So I'm not going to be speaking in this lecture particularly about, you know, how to make money from crypto in one day, how to become a billionaire in 1 week. But I'll be talking about the economics of cryptocurrency and the blockchain, the structure of the blockchain technology on which it runs on. Then I'll be speaking about, for people perhaps that are in other countries or other continents, so people looking to bring money in from Europe, people looking to bring money in from America, people that are looking in Asia to invest in Africa. Just giving a perspective in terms of what to look for in the African ecosystem and the peculiarities of the African ecosystem compared to perhaps investing elsewhere. Finally, I'll be looking at legal contracting in healthcare, so we'll be looking at term sheets and intellectual property issues, and I'm sure if there's any lawyers watching, this will be very interesting to you. And then the last lecture, number 10, we'll be looking at portfolio construction. So what type of companies would you put in your portfolio, and how would you sort of calculate that mix? And then we'll be looking at portfolio management, the kind of activities that you put in place to try and make sure these companies don't fail and they're adequately monitored. And finally, we'll be looking at the venture capitalist stream or the angel investor stream, the famous exit, and the ways that different companies exit, the way that venture capitalists or angel investors exit certain investments, and what that means, and how you can also help companies manage that exit process. So I look forward to this journey with you. It's 10 lectures, it's intense, but I want you to try and stay with me. You might want to watch it over a period of days or over a period of weeks, maybe one lecture every week, for instance, so it will take you 10 weeks to complete. You might want to sit down with a partner or a group or one of your mastermind groups or one of your mentorship groups and say, okay, we're going to go away on a retreat and go through all of these lectures within a weekend. It depends on your preference. But what I do want to sort of promise you is that I'll be sharing as much of my knowledge in almost 10 years in this industry in Africa as I can. And I really want you to have a good return on investment for your time. So now I'm going to move to the first lecture, Introduction to Angel Investing and Venture Capital. So in this lecture, I'll be talking about what angel investing is, why people go into angel investing, particularly with particular reference to our Catalyst Fund. I'll be talking about what our typical angels are, who they are. I'll be talking about the difference between angel investing and venture capital. And I'll be talking about some of the sort of hybrid people who have come into the space and the vehicles that they've come in with. So super angels, micro VCs, rolling funds, syndicates, and what they all are. So I'll start a bit about me. If you don't know me, my name is Dr. Ola Brown. And the doctor I'm not a doctor of finance. I'm actually a medical doctor. So I started life as a clinician in the UK. I then went on to be awarded an academic fellowship. So I went off to GK University in Japan, and I did academic research there. And then I started a business in healthcare here in Nigeria. I started an emergency services business. And then I left that business, and I'm still on the board of that business, but I stopped operating that business to go on into my career in angel investing and venture capital, where I am now. I also have an academic background in finance. I have a master's degree in finance, which majored in economic policy. So I like to think that I'm operating most of the time at the intersection of healthcare, finance, and economics. So what is angel investing? Angel investing is a type of private equity investing in which usually high net worth investors, executives for instance, or entrepreneurs, attempt to earn higher returns by taking on more risk compared to the public market. So lots of people will have their, like I said, Dangote shares or Flour Mills shares. And what are the dividends that you get on those shares? I can only remember the dividends on UBA shares last year. I think they were 30 kobo or 35 kobo per share, right? So there are executives, there are entrepreneurs in Nigeria or in other countries across the world that say, I want to take a bit more risk. And we'll be talking about risk in our portfolios in later lectures. So I'll be talking about risk in my lecture on cryptocurrencies. We'll be talking about balancing out your portfolio. But also, if you want to learn a bit more about risk and portfolio risk, then I also have a lecture on my YouTube channel. So if you go to Dr. Ola Brown YouTube, then there's a lecture called Banking in Capital Markets, where I go through risks in portfolios. So if you're thinking already, I want to learn more about what to put in my portfolio and what kind of risk, then you can watch that video. But back to this, angel investing. So angel investing is a type of private equity investing where high net worth individuals attempt to earn higher returns by taking on more risk compared with investing in the public markets. And angel investors typically finance a business at its very early stages. So most people that are watching are high net worth individuals, executives that work in companies, entrepreneurs that have started companies, people that have perhaps inherited money that are thinking, I'm tired of the stock exchange. I'm ready to take a little bit of extra risk with a proportion of my portfolio and earn those higher returns. So why do people go into angel investing? The reasons that people go into angel investing really vary with the investor. Some angels look at it as a way to diversify their portfolio. So in Nigeria, for instance, a lot of people invest in land, they invest in real estate, and their portfolios are really real estate heavy. A lot of people are invested in Nigerian government treasury bills, for instance, and those give you a stable return, a reliable return. People call them risk-free assets. They're not completely risk-free, but if you're giving your money to the person that prints money, then it's relatively risk-free, right? But you don't get a much higher return than the rate of inflation because the rate of inflation in Nigeria is pretty high. So therefore, people that, one of the reasons why people go into angel investing is they want a way to diversify their portfolio to include high risk, high return, a high risk, high return asset class. And that's just a proportion of their portfolio that they say, I've got this pot of money and I don't want to use it to buy more treasury bills because I know what the return is and it's not that better than inflation. And I want to take this pot of money and take a chance with this and get the chance of a higher return. Some angel investors aren't that well versed in portfolio theory at all, or aren't that interested in the portfolio. They just want to give back to entrepreneurs and support teams, companies, missions in which they believe in deeply. Some angel investors invest just because they want to stay current and active and learn about new technologies and businesses. Some angels view it as a networking opportunity. So some people, for example, offshore offshore engineers in Nigeria, a lot of people work in the oil and gas industry, and they spend, probably half of the year in a small box in the middle of the sea with like 20 other people. And they might, see it as not just an opportunity to diversify their portfolio, not just an opportunity to give back, but also an opportunity to see other people and to build their network. If you're spending 6 years in the middle of 6 months, per year in the middle of the sea, then when you get back onshore, you want to network, you want to meet people, you want to talk about different ideas, and that might be a good networking opportunity. And some people, it's a whole combination of the things that I've mentioned. So diversification, yes. Support teams and missions, yes. A learning opportunity and a networking opportunity, and sort of some kind of mix of all of those. Who are our typical angels in our collective? So the kind of people we see. Again, similar to the quote from Founders Club on the previous slide. They're entrepreneurs that want to diversify and share knowledge. So some people, for instance, entrepreneurs, operate traditional businesses in Nigeria. They operate manufacturing businesses. They operate supermarkets. They're in the hairdressing business or the beauty business, and they think, what? My business is making cash for me, but I want to get into this technology space. I want to diversify without necessarily starting a new business. And I want to share the knowledge that I have as an operator, as somebody that has operated a business, with these people that perhaps have never operated a business but have great technological ideas and are maybe a bit more tech savvy than I am. Senior executives are, people that we see typically joining our Catalyst Fund as well. And senior execs in different companies, blue chip companies, are on a fixed salary. And it's usually a good salary. And it would be a bit risky to leave that salary and go and start a business, right? When you get to a certain level in your career, considering the economy in Nigeria and the economy in Africa, it becomes a much, much higher risk to go and jump into entrepreneurship that is not sure. But a lot of these executives do have a lot of entrepreneurial energy and want to do entrepreneurial things. And one of the ways that they find to express that entrepreneurial energy is to support these teams informally as advisors, as investors in these startups. Also, we have a lot of subject matter experts, and because the Catalyst Fund focuses on two sectors, we focus on healthcare and we focus on financial technology, we have a lot of bankers, a lot of medical doctors, a lot of pharmaceutical executives, a lot of people in those sectors that know the sector inside out, know the level of support that they can give to these companies, and they join because they know what they know, and they know that they can add a lot to these companies that are starting out. Some people want to break into VC at some point, or they want to raise their own institutional funds at some point, and they join an angel collective like ours to begin to build their track record. So when they go and raise their own funds, they can say that these are the deals that I've done over a period of this many years. This is how successful they were. I've chosen these deals. This is my track record. It's something to speak about if they want to move into VC, if they want to work in a VC fund, or if they want to raise their own VC fund. It's a good sort of way to be able to demonstrate your expertise when you've actually put your own money into deals and they've been successful. And then, of course, there's people that want to diversify their sources of income. Land in Lekki and houses can only take you so far, right? Particularly when the currency is losing value. If you're investing in blue chip shares on the Nigerian Stock Exchange, again, those are quite different investments from the kind of risk-return portfolio, risk-return ratio that you would see in a typical angel investment. So Nigerians invest in land, Nigerians invest in stock, Nigerians invest in gold. So yeah, if you buy gold, how much gold can you really buy, right? And what does that really mean? So again, people that invest in these more traditional asset classes might say, you know what, like I have enough of this. I want to diversify my portfolio and diversify my sources of income. So those are our typical angels. They usually fall into these 5 buckets, but sometimes it's a combination. So now, what's the difference between angel investing and venture capital? It's a spectrum. So on one side, you have an Andreessen Horowitz, for example. Andreessen Horowitz is one of the most successful venture capital companies in the entire world. Silicon Valley firm based in America. And I mean, they're bigger than Zenith Bank. They're bigger than Access Bank in terms of the amount of funds that they have. Andreessen Horowitz just raised a $9 billion fund to focus on crypto. And they probably have, 10 of those size of funds currently under management. So you're talking about probably, in terms of money, $100 billion or more in terms of the funds that they have and they're managing right now and putting into companies of the future. Y Combinator, the very, very large venture capital firms are typically bigger than Nigerian banks. And that's on one side of the spectrum, where they have these huge amounts of money from American pension funds, for instance, the large pension organizations, from large family offices, from high net worth individuals, and they're able to raise these. I mean, just to put it into context, I don't think there's any bank in Nigeria that makes up to $1 billion in profit. Not one. Yeah, not one. I think last year, if I'm not mistaken, Zenith Bank did about $209 billion. $1 billion is 500 billionaire. So if you're talking about Andreessen Horowitz, just one of their funds, and they probably have like 10 to 15 funds running now, and one of their funds is $9 billion. Context, right? Huge size VCs. And on the other side of the equation, you have angel investors, somebody who's invested in her daughter's business. And she's taken money out of her savings, out of the family savings. Her daughter is starting a business. And she's put some of her personal money into the business to help her daughter with her business. And that's typical. So her mom is an angel. And then we have all the stuff in between that. So we have Andreessen Horowitz on one side as a VC. You have, mom and dad on the other side as a form of angel investing. And then you have what goes on in between, which is much smaller VC firms. I mean, there's a whole variety of venture capital firms in Nigeria, across the world, and very few of them are as big as Andreessen Horowitz, right? And then as you get into angel investing, you have angel investing networks or collectives where large groups of people, some from all around the world, gather together to invest in different startups, and those are quite large, sophisticated angel networks. Some of the angel networks even have several staff that help them invest. And that's why I say that it's a spectrum. And in between that spectrum, there's a sort of blurring as to what constitutes a VC and what constitutes an angel, because in between Andreessen and mom, there's a lot of activities happening. And a very, very large sort of super angel might be bigger than a small VC. But I think the difference is also in structure and distribution. Typically, angels are investing their own money directly into companies. Although the equation changes when you have angel collectives, where they are all investing their own money. They're not taking it from anybody else typically, but they are letting somebody take care of the management of those funds for them. Whereas VC, a typical VC, will go out to the pension funds, will go out to the family offices, will go out to the high net worth individuals, will go out to the foundations, will go out to the corporates, and raise these large amounts of money and say, for a fixed number of years, I'm going to look after this money for you in exchange for a management fee. And then at the end of this 5 years, I'm going to agree to a particular hurdle rate that I have to give you. And if I hit that hurdle rate, then any money from exits beyond that hurdle rate, we get to split in a certain way. So the difference between angel investing in VC in terms of, there's a number of different things that I can say, but the first point is that it is a spectrum. The second point is typically an angel will do smaller checks than a VC. So you see angels doing $500 checks. You see angels doing $1,000 checks into companies. You wouldn't typically see a VC doing that unless it was a mini micro VC. Typically, VC checks are bigger. But like I said, you see the super angels doing pretty big checks. So again, that's why I say it's a spectrum. But typically, angels do smaller checks than VC. I also spoke about the fact that angels, typically, it's their own money versus institutional investors. But again, there's been this blurring of the lines where these super celebrity angels, actually people do invest in them and they still call themselves angels. And people come and say, look, invest my money for me. So like I said, there's been a blurring of the lines, but typically, angels are investing their own money and institutions invest money in the VCs. The typical background of a VC is one of an investment banker. So most VCs come out of McKinsey & Company or are new graduates from top tier schools or are ex-investment bankers. But most VCs, I would say probably 50-60%, right, have never operated a business before. They know how to analyze businesses, but they've never actually had the experience of operating a business before. There are a new class of VCs, and that's why I keep on saying it's a spectrum now, because there's a new class of VC called operator VCs, but typically VCs aren't experienced operators, whereas angel investors tend to be, like I said, executives or entrepreneurs that have had the experience of operating a business before. Angels tend to be a lot more active and a lot more, involved in coaching and mentoring than VCs. Although some VCs do give a lot of mentoring as well and a lot of support, and firms like Anderson Horowitz, for instance, have whole departments that support their startups with marketing, with HR, recruiting, this kind of thing. So again, like I said, it's a spectrum, but I'm using the typical traditional definitions of saying they're not typically active. And one thing is, I think, is not a spectrum, is that VCs invest in tech. And that's what they do. It has to be technology enabled or technology companies. Whereas angels can invest in cement, they can invest in rice, they can invest in hairdressing, they can invest in anything, they can invest in a chain of restaurants. In our fund, it's health tech or fintech, but there are all kinds of angel groups that invest in all kinds of businesses, and they're still called angel investors. So these are the differences from my perspective on angel investing and VC, but as you can hear, there's a lot of crossover, and those lines over the years have become quite blurred. So that's actually the end of my lecture on VC and venture capital. So I'll just recap. I started by giving you a definition of angel investing and explaining why people invest. And then we explored the different personas from our perspective that we've seen as members of our Catalyst investing collective. And then I also explained the difference between angel investing and VC. But I think the key thing that I wanted you to take away is it is a spectrum and there's a lot of crossover between the two. Thank you very much.